This is Arif. I wanted to teach you guys how to do the options trade in the simplest way possible with an example instead of going through a text base. So I'm going to go ahead and show you what option trades are, how you can do them, the risks, and what you can do to prevent the risk. And I just wanted to let you know that option trading is highly dangerous. You can lose all your money, and you can see here what I mean by lose all your money. And you can also gain serious money if you are investing in the right company in the right time. And just wanted to let you guys know as well, option tradings are volatile. It can go up really high, it can go down really high, and if it goes down, you know how fast it's gonna go down. Like, you can lose all your money and you'll be left with nothing. So be careful with option trading. Only play with money that you can afford to lose, that you won't cry about or be upset if you lose that money. If you are taking money out of your savings account or any account, please just don't do it. Just don't do it. You will regret it. I regretted it. I took out my life saving and I lost everything. So just be careful with it. All right. So I'm not gonna hold any of you guys up anymore. So let's get started. So I'm gonna give you an example with Neo, since this has been a very really hot stock. So let's say Neo, this is the options call, so ignore that. This is the ticker symbol Neo, currently trading at 62.31 after markets. It's up 28 cents, and today it's down 66 cents. So what is options trading? If you are in your Robinhood account, you will see this option here called Trade Neo Options. If you're using the mobile app, if you are looking at it right now, you should be able to see an option on Neo. If you go to the ticker symbol Neo on your phone, you'll be able to see an option that says trade on the lower button. So if you click on trade, you will see there's an option that says trade option, sell or buy. You're going to be always clicking on trade options on the phone, and on the computer you'll be clicking on trade Neo options. So either way, they're both the same. It's just two different interface. One is on the computer and one is on the phone. So if you click on trade Neo options, you will see a bunch of dates, and you will see on the top buy, sell, call, put, and then you will see expiring. This is the expiration date. Remember, all Neo stocks, all stocks with options have expiration date. This is not your regular day trades where you buy a stock. This is completely different, and it's a strategy wise call options. That means they do expire, meaning let's say you buy this call here, and I'll explain why. So if you buy this call at $62, this is the strike price. You can see here, this is the strike price, meaning you're saying, okay, I will buy Neo at this price, $62, and to break even, meaning that you will make the most profit if Neo goes up to 64.28, which means a 3% increment. And to change, right, this part here, number change, this is the percent that is down right now. Like, Neo is completely down 36% right now since the 52 weeks high. And change option here, then you will see this price. This price is basically the price for you to get in the option call with. So since I have a January 15 call here, what I can do is click on this price here. You can change the date to any date you like. Remember, all the dates are at any time you desire, but the further the dates you go, the more it's going to cost you. For example, if you look at this $62 call on January 15, it will expire. If you're up to even $63, $64, you will be making profit. But if it goes down below whatever you're buying at, you will lose money. Meaning, let's say, um, let's take a look at this call here. For January 22, you will see the same $62 call cost $380. Why is that? Basically, what this means is that you're buying this call for a further time, meaning you have enough time in case Neo drops. You have extra time for the trade to go up, so you're not going to lose that much money. So when you're doing trading and you choose the January 22 date, you will see that the price will change. If you choose January 29, you will see the $62 call will change price again. So basically, the further you go, the more money you pay, because you're paying for time. You're paying for time because the options have more time to either grow up. If you're losing money, it will somehow make up the money from there. So since you're buying time, it has high chance of going up, so you're paying extra. But if you are doing January 15th call, then you'll be paying a lot cheaper for that same $62 calls. Like for example here, $62 call, you'll be paying cheaper. Now I want to explain one more thing here. The share price, $62.32. If you look up here, the $62.50 is cheaper than the $62 call. Why is that? Basically, what this means is anything below this share price, this big line here, means anything below this is in the money. What is in the money? Meaning, whatever you buy here, you have a chance of making more money than you would with out of the options money. Anything above this price is out of the money, meaning it's not as expensive as this, but it is a way for you to make less money. Doesn't mean you're not gonna make money. It's a higher risk. So I will explain why here. If you see here, this price costs $228, and if I click on this, then you can see that the call will expire on the 15th, and you have to select buy a call, which means you will be buying a call instead of, we'll go through these later, but this is the most important part that we need to worry about right now. So you need to know to click on this buy call, not sell put, not buy put, only buy call at the moment. We'll go through the rest later on. So again, here we have the share price, and here we have the strike price at what we want to buy it at. So if you select this, and you will have the $62 call, it's a long call, and then you're paying $228. Whatever the price you see here, $228, you may seem that, oh, that's so cheap, but you have to remember options are 100 times, meaning each call is multiplied by 100. So 228 multiplied by 100 is 200, and multiplied by 1 because you're buying one option for 100 shares, so you'll be paying $228 for the share. If we go ahead and click continue, here you will see contracts. You see it says 100 shares each. So if you buy one contract, you'll be buying 100 shares of that contract, and you'll be paying $228, as you can see here, and expires. A lot of people get confused by this. This means you're setting a limit order here at 225, 231. You can choose your price limit. If you want to buy it at 225, you can select 225. So if someone is selling it for 225, you'll buy it at 225. And good for day. This means that market opens at 9:30 and closes at 4 o'clock. Throughout that time, you will have this contract still going. So if within that time, if someone is selling at 225, your contract will be purchased for $225. This means this is good for the day. If your contract is not purchased, Robinhood will automatically cancel your order, and they will return your $225 back to your buying power. So if you see that it got rejected, it's because someone didn't sell for you to buy. So if we go ahead and click on review order, we can submit the order, and you can see here you're paying $225 for the right to buy 100 shares of NEO at $62 per share by January 15. And this is very important. If NEO shares earn 62 or higher on January 15, this option will expire worthless. What does that mean? Meaning, if NEO doesn't hit $62, which is as right now, your option will expire worthless, meaning you lose all your money. And you can sell at any time. Options means money. If you're buying a call for January 15, it doesn't have to be that you have to wait till January 15. You can sell it at any time. Before this, you can even sell it the day you buy it. You can sell it the next day you buy it. So right now, today is January 13. You can sell it on January 14. That's how options work. So if we submit this right now, it will stay in the queue, and then when the market opens, it will go ahead and do that, like the fill the order. If you select here on Robinhood, I believe you need to get approved for this option, but let's cancel that. And if we click on good for day, good till canceled, this option here, good till canceled, meaning within this 90 days this order will be active. So if someone is selling the NEO for $2.25 per share, you will be purchasing it until the 90-day has reached. So anytime within the 90 days, you will still be able to purchase your share. So that being said, it's basically I always go for good for a day. I don't chase stocks. I normally just get at whatever price it's at, and I click review order, and I click submit, and it will be staying in the queue. So if you go to the cash section here, you can see that I'll show you my old NEO actions that I had before, and we can go to NEO here. So I did make serious gains with NEO, and I recently just got back into NEO with the these two calls that I'm losing $40 on right now. But if we go to the history section here and click show more, all right, so let me go down here all the way. All right, so on March 14th I bought shares of NEO at $6. This time I didn't even know that NEO was what company it was or anything. I just saw the hype and I just bought 5 shares because I didn't have enough money that time, so I just bought 5, and I'm gonna continue to hold it. And if you see here, when NEO was hovering around $43 on December 28th, you can go back to the chart to see it. I bought 2 shares at $5 call, and I paid $1,000 for it. Then the next day I sold it for $120. This was a mistake. I sold it because it wasn't going anywhere and it kept going down, so I wanted to sell it and get back into the game. So the next day I went back in and I got in with 3 contracts at $1,000. This is the amount I paid for this call, $45.50. That was supposed to expire on 1/22 of January this year, 2021, and I was trying to buy more, but the orders weren't getting filled, so I decided to cancel the orders. Then on January 6th, you guys know what happened in the Washington DC with all those riots and everything that's going on. So the market did crash, and that gave me the opportunity to buy more. So I decided to get 2 more of NEO when it went down, and I was able to get these 2 calls here. And later I was able to get another call and another one. So in total I was able to get 6 calls on NEO. I was trying to place more, but it wasn't going through. So on January 11th, you can see that I sold all of my Neos because of the Neo news and everything that was going on. There was a lot of hypes. So if you looked at my previous cost for $50.50, which was the 15th, you can see $50.50. If we go down here, $50.50, which is right around here. Yeah. So I paid $419 and I sold that contract for $1,320. So you have to subtract that $400 that I paid minus this price in order to get the actual profit. So whatever the amount is, the subtraction, that's the profit that I made on this. And here you can see this $45 call. I made the most profit here, and I paid $1,600 here. So I made a total of $5,400. So if we do a calculation on that, I paid 1606, if I'm not wrong, 1605. Okay, so 1605, and I did 5,400. So minus 5,400, I made a total profit of $3,795 on that 3 calls that I had. So that's how contracts work and options calls work, with just a little explanation. This video got long. I didn't expect it to be this long, but if you have any questions, feel free to let me know. I'll be happy to help. And if you need any other assistance about the call options, or if you're not sure about how the call option works, let me know. I will do my best to assist you with that. And these are just some of the calls that I have, but please do not get what I have here, because these are at high price right now, and you should not be mimicking what I have currently. If you need any information, I will be posting all the videos and everything up soon, so you'll be able to watch those videos. But don't try to copy anything from here, as these are the old calls that I had before, and I'm just holding them at the moment. As you can see, I'm losing $400 with Apple, $600 with Microsoft, and these are all call options. So I am down a lot, but you can see here that this call here, Fubo, I caught it today at, I'll show you exactly when I got it today. I got filled today at 11:24 a.m. on January 12th, and you can see that just on that couple of hours before the market closed, I made a $365 profit. This is my profit. This is how much it cost me. I made this much money after paying this much. So I paid $600 and I made $365 profit. So, which is why currently my market value is $365, because look, I paid $600, I made $365 profit. So if you add this number with this 600, you get 965. So this is your total profit, like total market value, but your total profit is always going to be total return, which is $365. And today's return is based on it. This resets every single day. So next day this will reset back to 0, and whatever you earn tomorrow is going to add up over here on your total. But you should always be looking over here in your total return, not today's return. Today's return, you can look at it, but total return is all that matters, because this will calculate from all the downs and ups and everything. This will be updated from there. And you can see my break-even price is $37, and Fubo is currently sitting at $36.95. So in about a couple of cents more, I'll be hitting my break-even price. But it doesn't have to be exactly $37. I can sell it way before that even reaches my break-even price. So don't get confused about the break-even price. And this is the average share price at $6, which costed me 6 times 100, which was $600. This is the strike price, not the actual price of the stock. This is the options call for it. So if we go to options, and I picked, I believe, January 15th, and I picked I don't remember which call I picked. It was in the money, or January 22. I'm not sure which one I picked. Let me go back and check. So my call expires on February, so I can hold this stock until February and it won't expire. So until February 12, whatever it goes up, I make money. If it goes down, I lose money. And one more thing that I wanted to explain to you is, in options call, you lose what you put in, meaning whatever you have on your buying power doesn't get affected. This is your buying power. It's like your wallet. This doesn't touch it. What touches is what you put in. So for this call, I put in $600. I can lose $600, not anything below $600. If you do purchase any stock, you can only lose what you put in, not anything more than that. And by the way, this Robinhood account is my cash account. This is not a margins account. I don't do margins. I don't borrow money. I play with what I have and what I can afford to lose. So you can see here that $600 is what I paid and is what I can lose. That's very important to keep in mind. And here we have the today's total return, $365. This amount can go unlimited. It can go to 5,000, it can go to 10,000, it can go to 20,000. This is unlimited. But if it does go down, you lose $600. And that's the maximum amount you can lose. And I'll give you an example of that. So when there was a hype about PFE, I decided to buy a call on it, and I bought the $41 call for expiring in January 15, and I bought it on December 14, 2020, because there was a lot of hype about it. So I decided to buy it, and look what happened. I bought it and I lost all of my money. I put in $263 and the stock crashed down to $37.13 instead of going up. So I lost my money there, and you can see here I paid $263 and I lost $261. My current value is $2, which is 261 plus $2 is 263. So what you put in is what you lose if the stock goes down. If it goes up, you have unlimited potential to make money. And this is how the options call work. I hope this 23 to 24 minute video has helped. If you have any confusion, please don't forget to reach out to me. I'm always available on the Discord chat. So if you have any other questions, go ahead and let me know on the chat. I'll be happy to help you. Alright guys, good night.